Welcome to Books and More, the channel where ideas meet wisdom and stories become lessons for life. Today, we dive into one of the greatest investing classics of all time, A Random Walk Down Wall Street by Burton G. Malkiel. This book isn't just about money, it's about mastering the art of patience, discipline, and rational thinking. Malkiel reveals why markets are smarter than we think, how randomness shapes prices, and why the simplest investment strategy often wins. If you want to understand how to build lasting wealth calmly and wisely, this journey will open your mind to the power of the random walk. Stocks and their value. In the opening part of A Random Walk Down Wall Street, I invite the reader to join me on an intellectual journey through the world of investing. A journey that challenges long-held beliefs about how markets work and how wealth is truly built. The essence of this section is simple yet profound. While markets may seem chaotic, there is order hidden in their apparent randomness, and understanding this is the key to successful investing. I begin by explaining what a random walk really means. In finance, it suggests that stock prices move unpredictably, that their short-term changes are largely independent of past movements. No analyst, no chartist, no forecaster can consistently predict what the market will do next. This idea offends many professionals on Wall Street, who prefer to believe that superior knowledge or sharper intuition can outsmart the market. Yet history and data consistently prove otherwise. The truth is uncomfortable. In the short run, the market behaves like a drunkard staggering down the street, each step random, directionless, and unaffected by the last. From this foundation, I distinguish between investing and speculating. Investing, to me, is the disciplined act of purchasing assets that promise reliable long-term returns, dividends, interest, or appreciation grounded in real economic value. Speculation, in contrast, is a bet on short-term price changes fueled by emotion, rumor, or the crowd's enthusiasm. The difference between the two is not merely in time horizon, but in mindset. The investor seeks growth over decades. The speculator seeks excitement over days. My book is for the investor, for those who accept that true wealth is built slowly but surely through patience, reason, and consistency. To frame the debate over how assets are valued, I introduce two competing schools of thought, the firm foundation theory and the castle in the air theory. The firm foundation approach holds that every asset has an intrinsic value determined by careful analysis of future income, discounted to the present. This is the classic view espoused by Benjamin Graham and David Dodd, and exemplified by Warren Buffett. According to this logic, if a stock trades below its intrinsic value, it's a buy. If it trades above, it's a sell. The challenge, of course, lies in accurately forecasting the future, a task that is far less scientific than it appears. The opposing view, the castle in the air theory, is grounded not in arithmetic but in psychology. Originating from John Maynard Keynes, it suggests that prices are driven less by intrinsic worth and more by what investors believe others will believe. In other words, the successful speculator builds castles in the air, buying not because something is truly valuable, but because others are likely to think it is valuable soon. In such a world, perception becomes reality, and market prices float on waves of optimism and fear rather than on firm economic ground. This perspective explains many of the market's wildest episodes, where rational analysis is swept away by collective euphoria. To demonstrate how mass psychology distorts markets, I recount the madness of crowds. From the tulip mania of 17th century Holland to the South Sea bubble in 18th century England, history shows that greed and human folly are timeless. During the tulip craze, ordinary citizens traded their homes, livestock, and fortunes for a few rare bulbs, convinced that prices could only rise. When the illusion broke, ruin spread as swiftly as the mania had. The same pattern repeated in the South Sea bubble, when investors poured money into a company that promised vast riches from trade with South America, despite having no real operations at all. Fraud, optimism, and the desire to get rich quickly combined to inflate prices far beyond reason, and when the bubble burst, countless lives were destroyed. These stories remind us that financial markets, for all their sophistication, are still ruled by the ancient forces of fear and greed. Yet, speculative folly is not confined to the distant past. I trace its recurrence through the 20th century, from the go-go 60s to the internet frenzy of the 1990s. In each era, new technologies or economic narratives ignite dreams of limitless wealth. In the 1960s, conglomerates promised synergy and endless growth. In the 1970s, the Nifty 50 stocks were hailed as one-decision investments that could never fail. By the 1980s and 1990s, biotechnology and high-tech companies fueled a new era, as investors believed that innovation had rewritten the rules of valuation. The same excitement swept Japan, where real estate and stock prices rose to absurd levels, driven by national confidence and cheap credit. Each time, investors claimed that this time is different. Each time, they were wrong. The early 2000s brought two bubbles of staggering magnitude, the internet boom and the housing mania. The dot-com era demonstrated how easily hope can overpower reason. Companies with no profits, sometimes not even revenue, achieved astronomical valuations based on little more than a domain name and a dream. Analysts invented new metrics to justify the unjustifiable, while the media cheered from the sidelines. When the bubble burst, billions of dollars vanished overnight, and faith in the market's efficiency was shaken. Yet, scarcely a few years later, the housing bubble emerged, fueled by easy credit, reckless lending, and the widespread belief that home prices could never fall. Financial engineers sliced and repackaged risky mortgages into securities that were sold worldwide, spreading the illusion of safety. When reality intervened, the collapse triggered a global financial crisis, proving once again that mass delusion can conquer even the most sophisticated systems. After recounting these episodes, I return to the core question: does the recurrence of bubbles and crashes mean that markets are inefficient? My answer is nuanced. Markets are not perfectly rational, but they are remarkably resilient. Prices may deviate wildly from intrinsic value in the short run, yet over time they tend to correct. The market is like a powerful ocean, unpredictable on the surface, but guided by deep currents that pull it back toward equilibrium. Investors who accept this truth, who resist the temptation to predict short-term waves, can harness those long-term forces to their advantage. Through these stories, I emphasize a few enduring lessons. First, human psychology is the constant enemy of sound investing. Fear and greed, optimism and panic, these emotions have shaped every boom and bust since the dawn of markets. Second, innovation and new technology, while transformative, often serve as the spark for speculation. Each generation believes it has discovered a new way to create wealth effortlessly, forgetting that true value grows slowly, not explosively. Finally, the only sustainable investment philosophy is one grounded in humility, in acknowledging that the future is unknowable and that the wisdom of crowds, while imperfect, often surpasses the judgment of any individual. In my own experience as both an academic and investor, I've seen countless professionals fall victim to overconfidence. Analysts draw intricate charts, economists publish elegant equations, and fund managers make bold predictions. Yet most fail to outperform a simple index fund. This is not because they lack intelligence, but because they underestimate randomness. They mistake luck for skill, temporary patterns for permanent truths. The beauty of the random walk theory is that it liberates investors from this illusion. It teaches us that we don't need to outguess the market to succeed, we simply need to participate in it intelligently, with patience and discipline. To prepare readers for the deeper analysis in later chapters, I conclude Part 1 by setting the stage for the random walk itself, the guided tour that will explore how professionals play the game, how theories like modern portfolio management have evolved, and how behavioral biases shape our decisions. But before venturing further, it's essential to internalize the lessons of history. The speculative bubbles of the past are not just curiosities. They are warnings etched in financial memory. They remind us that markets are reflections of human nature, and human nature does not change. In the end, the message of Part 1 is both humbling and empowering. The stock market is not a puzzle to be solved, but a force to be understood. Its movements may be random in the short term, but over the long term, they mirror the growth of real economic value. Investors who accept this truth can focus their energy not on prediction, but on participation, not on timing the market, but on time in the market. As I guide you deeper into this random walk, remember that the greatest edge any investor can have is not superior information or secret formulas, but temperament. The ability to remain rational when others are losing their heads. That, above all, is the foundation of enduring success on Wall Street. How the pros play the biggest game in town. In this part of a random walk down Wall Street, I turn my attention to the professionals, the analysts, traders, and portfolio managers who dominate the world's financial markets. Their language is technical, their confidence is unshakable, and their suits are expensive. Yet, beneath the surface of sophistication lies a humbling truth. Despite all their charts, models, and forecasts, most professionals fail to consistently outperform the market. This section examines the two great schools of thought that guide their efforts, technical analysis and fundamental analysis, and measures them against the theory of the random walk. The goal is not to ridicule expertise, but to reveal its limits and to show why, for most investors, simple strategies often triumph over elaborate ones. I begin with a confrontation between technical analysis and fundamental analysis, the twin pillars of professional investment practice. Technical analysts, sometimes called chartists, believe that market prices move in patterns that reflect investor psychology. They study past price movements, trading volumes, and chart formations, convinced that these data contain clues to future direction. In their view, markets have memory. Trends and momentum exist, and if you can recognize them early, you can profit from them. The tools of the trade are countless: moving averages, resistance levels, head and shoulders patterns, and many others that have been recycled for decades. The appeal of technical analysis is emotional as much as intellectual. It gives investors the illusion of control in an unpredictable world. Yet, as I explain, the logic of technical analysis breaks down when tested. If price changes are truly random, then yesterday's movements tell you nothing about tomorrow's. Decades of research have shown that chart patterns, no matter how sophisticated, fail to yield consistent excess returns once transaction costs and taxes are considered. The market's short-term fluctuations resemble a drunkard's path, sometimes trending upward, sometimes downward, but always unpredictable. For every technician who claims success, there is another who fails miserably. Indeed, the persistence of technical analysis on Wall Street says more about human psychology than financial science. People crave patterns, they prefer stories to randomness, and they find comfort in the idea that skill can conquer uncertainty. That is why, despite its repeated failures, charting remains alive and well in every trading room. Fundamental analysis, the other major approach, is far more respectable and intellectual. It seeks to determine the intrinsic value of a stock by analyzing the company's financial statements, management quality, industry position, and future prospects. Fundamental analysts try to find undervalued or overvalued securities, buying when the market price falls below intrinsic value and selling when it rises above. The method rests on a reasonable premise. In the long run, price should reflect value. But the challenge lies in calculating that value. Forecasting a company's future earnings, dividends, and growth is an exercise fraught with uncertainty. Even the most careful analyst must make assumptions about interest rates, inflation, technological change, and competitive behavior, variables that no one can predict with precision. In practice, fundamental analysis often becomes an art of educated guesswork. Analysts, under pressure to produce confident opinions, rely on models that exaggerate their foresight. Worse, their forecasts are distorted by behavioral biases and institutional incentives. Many analysts work for investment banks or brokerage firms that profit from selling securities. Their recommendations, therefore, tend to be optimistic. Few analysts ever issue sell ratings because pessimism is bad for business. Others fall prey to the psychological traps that plague all humans: overconfidence, confirmation bias, and the tendency to mistake luck for skill. That is why, despite its repeated failures, charting remains alive and well in every trading room. Fundamental analysis, the other major approach, is far more respectable and intellectual. It seeks to determine the intrinsic value of a stock by analyzing the company's financial statements, management quality, industry position, and future prospects. Fundamental analysts try to find undervalued or overvalued securities, buying when the market price falls below intrinsic value and selling when it rises above. The method rests on a reasonable premise. In the long run, price should reflect value. But the challenge lies in calculating that value. Forecasting a company's future earnings, dividends, and growth is an exercise fraught with uncertainty. Even the most careful analyst must make assumptions about interest rates, inflation, technological change, and competitive behavior, variables that no one can predict with precision. In practice, fundamental analysis often becomes an art of educated guesswork. Analysts, under pressure to produce confident opinions, rely on models that exaggerate their foresight. Worse, their forecasts are distorted by behavioral biases and institutional incentives. Many analysts work for investment banks or brokerage firms that profit from selling securities. Their recommendations, therefore, tend to be optimistic. Few analysts ever issue sell ratings because pessimism is bad for business. Others fall prey to the psychological traps that plague all humans: overconfidence, confirmation bias, and the tendency to mistake luck for skill. The result is that the forecasts of even the most respected professionals often prove no better than chance. Studies repeatedly show that the consensus estimates of Wall Street analysts are poor predictors of future earnings, and that their stock picks rarely outperform the market averages. This leads naturally to the EFIUM hypothesis, a theory that grew out of academic research in the 1960s and 1970s. The EFIUM hypothesis asserts that all available information is already reflected in stock prices. In an efficient market, competition among investors ensures that prices adjust almost instantaneously to new information. Therefore, no one can consistently achieve higher returns without taking on greater risk. The implication is profound. Both technical and fundamental analysis are largely futile because whatever insight they offer is already embedded in the current price. If a company's prospects improve, investors rush to buy. If its outlook worsens, they sell. The collective actions of millions of participants incorporate that knowledge into prices faster than any individual can react. The efficient market theory comes in three forms. The weak form states that all past price information is already reflected in current prices, invalidating technical analysis. The semi-strong form adds that all publicly available information, including financial statements and news, is also absorbed, challenging the usefulness of fundamental analysis. The strong form goes even further, claiming that even insider information is reflected in prices, though this version is less realistic. The evidence for EMH is extensive. Mutual fund managers, professional stock pickers, and hedge funds, after adjusting for fees and risks, consistently fail to beat simple index funds. Some do outperform for a while, but their success is rarely repeatable and often indistinguishable from luck. The conclusion is uncomfortable for Wall Street, but liberating for individual investors. You don't need to be smarter than everyone else to succeed. You just need to accept that the market, on average, knows more than any one of us. Still, critics argue that markets cannot be perfectly efficient, citing examples of bubbles, crashes, and irrational exuberance. They point to moments when prices clearly diverged from fundamental reality, from the dot-com mania to the housing frenzy. These episodes, however, do not disprove the theory. They simply remind us that efficiency is a tendency, not an absolute state. Markets are efficient most of the time, not all the time. But because we can never know in advance when inefficiencies will appear or disappear, exploiting them systematically is nearly impossible. As I often say, the market may not be perfectly rational, but it is far more rational than any individual investor. Returning to the professional players, I explore why so many continue to rely on methods that fail under scrutiny. The answer lies in incentives. Fund managers and analysts are not rewarded for humility, they are rewarded for activity and confidence. Clients prefer bold predictions to cautious ones, and they pay for the illusion of control. As long as investors demand guidance, Wall Street will supply it, even if the advice adds little real value. Moreover, the culture of finance celebrates action. To admit that markets are largely efficient is to admit that doing less is often better than doing more, and that truth is hard to sell in a profession built on motion. The second half of this part delves deeper into the mechanics and myths of technical analysis, exposing its seductive logic and empirical weakness. I dissect systems like the Dow theory, filter rules, and relative strength methods, all attempts to extract meaning from the noise of price data. Each system claims to identify trends or turning points, but when tested statistically, their performance collapses. Any apparent success often vanishes once we account for transaction costs, data mining, or sheer coincidence. Moreover, many of these indicators rely on ambiguous patterns that can be interpreted in multiple ways. A chartist can always find a reason to confirm his bias, whether the market rises or falls. It is a perfect example of what psychologists call the illusion of validity, the belief that one's judgment is sound simply because it feels convincing. To illustrate the persistence of such illusions, I describe the many market indicators that have captured public imagination, from the hemline index suggesting stock prices rise when women's skirts get shorter, to the Super Bowl index claiming the outcome of a football game predicts market performance. These theories are absurd, yet they thrive because people crave certainty. The truth that short-term price movements are largely random is unsatisfying. It denies us the comfort of patterns and the thrill of prediction, and so the myth of the expert endures. In contrast, fundamental analysts pride themselves on discipline and rationality. They pore over balance sheets, interview executives, and construct detailed valuation models. Their craft has produced legends, from Benjamin Graham to Warren Buffett, whose success stories inspire generations of investors. Yet, as I point out, even fundamental analysis suffers from serious flaws when practiced on a mass scale. Analysts face conflicts of interest between honest research and the demands of their employers. Many migrate to sales or portfolio management once they build a reputation, leaving behind a system dominated by mediocrity. Creative accounting practices further muddy the waters, allowing companies to present earnings that look better than reality. And even when analysts make accurate forecasts, markets often adjust so quickly that there is no profit left to capture. The cumulative evidence is clear. Both technical and fundamental approaches, as practiced by professionals, struggle to beat the market. This is not to say that analysis is worthless, only that it is extraordinarily difficult to translate analysis into consistent outperformance. For most investors, the time, effort, and cost involved outweigh the potential gains. The market's efficiency ensures that every advantage is fleeting and every mispricing swiftly corrected. As this part concludes, I reflect on what all this means for the individual investor. The lesson is not to abandon intelligence or curiosity, but to channel them wisely. The stock market is not a puzzle to be solved through endless analysis. It is a dynamic system that rewards patience, diversification, and low costs. The professionals, for all their brilliance, are trapped in a game where competition erases the rewards of skill. For you, the individual investor, liberation comes from stepping outside that game by embracing simplicity, accepting randomness, and trusting the power of long-term compounding. In sum, Part 2 reveals the central paradox of Wall Street. The more complex the strategy, the lower the odds of success. The pros play the biggest game in town, but the odds are stacked against them. For the thoughtful investor, recognizing this truth is the first step toward freedom. Once you stop trying to outsmart the market and instead align yourself with its broader rhythm, you begin to see investing not as a contest, but as a journey, one guided not by prediction, but by principle. The new investment technology. In this part of A Random Walk Down Wall Street, I explore the evolution of modern investment theory. the set of quantitative tools and behavioral insights that reshaped how we think about risk, return, and rationality. What began as a field ruled by intuition and speculation gradually matured into one grounded in mathematics, data, and psychology. Here, I introduce three major revolutions in finance: modern portfolio theory, MPT, the capital asset pricing model, CAP, and its extensions, and behavioral finance, which exposes the flaws in our supposedly rational decisions. Together, they form what I call the new investment technology. I begin with modern portfolio theory, one of the most important advances in financial thought. Before MPT, most investors evaluated securities individually, seeking the highest expected return without properly accounting for how each security interacted with others in a portfolio. Harry Markowitz changed that in the 1950s by proving that investors should not think in terms of single assets, but in terms of entire portfolios. His insight was elegant, yet revolutionary. The risk of a portfolio depends not only on the risk of each investment, but also on how those investments correlate. If two securities do not move in perfect unison, the combined portfolio can actually be less risky than its individual parts. This means that diversification, owning a mix of different assets, can reduce overall risk without sacrificing return. Markowitz also redefined risk itself. It was no longer about the chance of loss, but the variability of returns, the extent to which actual outcomes deviate from the expected. This can be measured statistically by variance or standard deviation. By plotting portfolios on a graph of risk versus return, we can identify the efficient frontier, the set of portfolios offering the highest possible return for each level of risk. Any portfolio below that frontier is inefficient because it gives up return without reducing risk. This insight formalized a truth that seasoned investors had intuited for decades, that diversification is the only free lunch in finance. However, MPT is more than an abstract idea. It has practical implications that transformed the investment industry. Pension funds, mutual funds, and individual investors all learned that the smartest approach is not to chase the highest returning stock, but to build a balanced portfolio of different assets: domestic and international stocks, bonds, real estate, and even cash, to minimize volatility. By focusing on the portfolio as a whole, investors gain a powerful edge, steadier performance, and fewer sleepless nights. Building on MPT came the capital asset pricing model, developed by William Sharpe, John Lintner, and others. Capital asset pricing model takes the logic of diversification one step further. It argues that in an equilibrium market, investors are compensated only for the systematic risk they cannot diversify away, the risk of the entire market. This risk is measured by beta, a statistical gauge of how sensitive an individual asset is to overall market movements. A beta of 1 means the asset moves in tandem with the market. A beta greater than 1 means it is more volatile, less than 1, less volatile. According to CAPM, the expected return of any asset is determined by its beta. The higher the beta, the higher the expected return, because investors must be compensated for taking on more risk. The relationship between risk and return is expressed through the security market line, which connects the risk-free rate, the return on treasury bills, to the expected return of the market portfolio. Any security above the line is undervalued, offering more return than its risk warrants. Any below is overvalued. This elegant model provided both a theoretical foundation for understanding prices and a practical benchmark for evaluating investment performance. A manager's alpha, the excess return above CAPM's prediction, became the measure of true skill. Yet, like all models, CAPM works beautifully in theory but imperfectly in practice. Real-world returns do not always follow the model's predictions. Some low-beta stocks have produced higher than expected returns, while many high-beta stocks have lagged. These discrepancies led to refinements such as arbitrage pricing theory, APT, which posits that returns are influenced by multiple factors: economic growth, interest rates, inflation, and market sentiment, not just one. Later, the FAMA French three-factor model expanded CAPM further by adding size and value as additional dimensions of risk. Smaller companies and undervalued stocks historically have generated higher returns than the market overall. These findings complicate the simple picture painted by CAPM, but they also remind us that the world is richer and less predictable than any equation can capture. Despite these refinements, one lesson remains unshakable. Risk and return are inseparable. Investors cannot expect higher rewards without accepting greater uncertainty. The challenge is not to eliminate risk, but to take it intelligently through broad diversification, low costs, and long-term commitment. The market rewards those who stay the course, not those who chase the next big thing. While MPT and CAPM focus on the logic of markets, behavioral finance examines their psychology. This field emerged from the realization that investors are not the rational, calculating agents assumed by classical economics. Instead, they are human, emotional, biased, and inconsistent. The work of psychologists Daniel Kahneman and Amos Tversky, along with economists like Richard Thaler, revealed the many ways our minds betray us in financial decision-making. One of the most pervasive biases is overconfidence. Investors consistently overestimate their ability to predict future prices, interpret random patterns as meaningful signals, and believe they can outsmart the market. This overconfidence leads to overtrading, which not only incurs higher costs but often results in lower returns. Another bias is loss aversion, the tendency to feel the pain of a loss more acutely than the pleasure of an equivalent gain. Because of this, investors hold on to losing stocks too long, hoping to break even, and sell winners too quickly, locking in gains, thereby reversing the buy low, sell high logic of sound investing. Then there is herding, the instinct to follow the crowd. In bull markets, optimism spreads like wildfire. In bear markets, fear takes over. People buy because others are buying and sell because others are selling. This collective behavior creates bubbles and crashes, the same patterns we saw in the tulip craze, the dot-com boom, and the housing bust. Rational analysis often succumbs to social proof, the belief that so many people can't be wrong. Yet, as history proves, they often are. Behavioral finance also identifies pride and regret as subtle but powerful forces. Investors often make decisions not to maximize wealth, but to preserve self-esteem. Selling a loser admits a mistake. Holding it offers hope. Pride pushes us to buy fashionable stocks for social validation. Regret keeps us from acting rationally when those same stocks falter. These emotions turn investing, which should be a process of dispassionate judgment, into a theater of ego and fear. The field doesn't stop at explaining individual mistakes. It also examines why entire markets sometimes behave irrationally. Collective optimism during booms and collective despair during crashes are not just stories of greed and fear. They are the predictable consequences of human nature amplified by feedback loops. Yet, behavioral finance is not purely pessimistic. By understanding these biases, investors can design systems that protect them from themselves. Automatic investment plans, diversified index funds, and strict rebalancing rules are all behavioral defenses. They impose discipline when emotion tempts us to deviate. I often summarize the lessons of behavioral finance in a few key rules. Avoid herd behavior. Crowds are usually wrong at turning points. Avoid overtrading. The more you trade, the more you lose to costs and emotion. If you must trade, sell losers instead of winners. Correct loss aversion. Keep a long-term perspective. Short-term noise means nothing in the grand arc of compounding. Do these insights allow investors to beat the market? Not reliably. Behavioral finance doesn't reveal a magic formula. It reveals our own weaknesses. Markets may not be perfectly rational, but they are efficient enough that exploiting irrationality is extremely difficult. The true value of this discipline lies in self-awareness. By understanding the psychological traps that ensnare others and ourselves, we can avoid catastrophic mistakes and build portfolios aligned with reason rather than emotion. In the end, this new investment technology represents the union of mathematics and psychology, the blending of cold logic with warm humanity. Modern portfolio theory taught us how to construct efficient portfolios. CAPM showed us how markets translate risk into return. Behavioral finance reminded us that even with perfect theory, human emotion still governs behavior. Together, they teach humility, that the market cannot be conquered, only respected. The conclusion of this part brings us back to the core message of the book. Markets are powerful, adaptive, and largely efficient, but not infallible. The task of the investor is not to forecast or outguess them, but to work with them, to accept uncertainty, to diversify widely, and to let time do the heavy lifting. The greatest tools in finance, the models, the data, the algorithms, can guide us only so far. The rest depends on temperament, the ability to stay calm when others panic, patient when others rush, and disciplined when temptation calls. That, above all, is the true essence of modern investment wisdom and the surest way to walk safely down Wall Street. Fourth part, a practical guide for random walkers and other investors. In the final part of A Random Walk Down Wall Street, I shift from theory to practice, from the elegant ideas of portfolio theory and behavioral finance to the concrete steps every investor can take to secure financial independence. This is the how-to section of the journey, where I translate decades of research and observation into practical wisdom. My goal here is simple: to help you design a plan that fits your life, your temperament, and your long-term goals. The advice that follows is not about predicting markets, but about mastering yourself. I begin this section with a simple truth. The greatest determinant of investment success is not the return you earn, but the discipline you apply to saving. No matter how brilliant your portfolio design or how sophisticated your financial knowledge, nothing substitutes for consistent saving. The earlier and more regularly you save, the greater the power of compounding will work in your favor. Even modest contributions made faithfully grow into substantial sums over time. Investing, like fitness, demands habit and persistence more than brilliance. From this foundation, I introduce a series of exercises, practical steps to build financial strength. The first is to gather your supplies, establish an emergency fund, obtain adequate insurance, and set clear financial objectives. Before you take any risk, you must secure the basics: cash for emergencies, health and life insurance, and protection against the unforeseen. Only once these are in place can you begin your random walk with confidence. Investing without preparation is like hiking without water, an avoidable disaster. The next exercise is to take advantage of tax-deferred accounts, such as IRAs, Roth IRAs, and employer-sponsored retirement plans. Taxes, not inflation, are often the silent killer of wealth. Every dollar you shelter from taxation compounds faster and longer. If your employer offers a retirement match, take it. It is the rare instance of free money. Likewise, if you save for a child's education, use vehicles such as 529 plans. A tax-efficient structure may not be glamorous, but over decades, it is the difference between getting by and true financial security. Another essential exercise is to understand your investment objectives, to make sure the shoe fits. Too often, investors chase returns without asking why they are investing in the first place. Are you seeking growth, income, stability, or a balance of all three? Your objectives determine your mix of assets and how you react when markets fluctuate. A person saving for a down payment in 2 years should not have the same portfolio as someone investing for retirement 40 years away. The right portfolio is personal. It reflects not only your goals, but your emotional tolerance for risk. From here, I guide readers into what I call the promenade through bond country, the world of fixed income investing. Bonds play a vital role in any balanced portfolio. They provide stability when stocks fluctuate, income when markets stagnate, and protection when fear spreads. There are many varieties: treasury bonds, corporate bonds, municipal bonds, and inflation-protected securities, TIPS. Each serves a purpose. For high earners, tax-exempt municipal bonds may be ideal. For those seeking safety, government bonds are unsurpassed. Foreign bonds can add diversification, but also bring currency risk. The key, as always, is balance. Bonds are the ballast that steadies the ship during storms. Next, I remind investors that costs are not random. They are the one variable you can fully control. Every percentage point in fees and expenses you save is a percentage point of return you keep. Over a lifetime, this difference compounds dramatically. Choose low-cost index funds or exchange-traded funds (ETFs) over high-fee actively managed funds. Avoid frequent trading, which incurs taxes and commissions. Ignore the siren call of exclusive opportunities promising high returns. They rarely deliver. In investing, simplicity and frugality are virtues. With these foundations laid, I turn to the problem of forecasting, or rather, the futility of it. In Chapter 13, Handicapping the Financial Race, I analyze how stock and bond returns have behaved across history. I divide the past century into 4 eras: the age of comfort, the age of angst, the age of exuberance, and the age of disenchantment. Each reflects different combinations of inflation, interest rates, and investor psychology. The lesson is that markets move through cycles, but timing those cycles is impossible. Even experts rarely predict turning points correctly. Instead of forecasting, investors should estimate broad expectations. Stocks over long horizons have historically returned more than bonds. Bonds have returned cash. This hierarchy exists because of risk, and it will likely persist. Your job is not to predict when it will change, but to ensure your portfolio is suited to weather any scenario. In Chapter 14, A Life Cycle Guide to Investing, I explain how the ideal portfolio changes with age. Investing, like life itself, follows stages. When you are young, time is your greatest asset. You can afford to take more risk because temporary declines are unlikely to derail your long-term goals. A portfolio heavily weighted toward equities makes sense in early adulthood. As you age and approach retirement, capital preservation becomes more important than growth. Gradually increasing your allocation to bonds provides stability and income. After retirement, the focus shifts again to generating reliable income while still protecting purchasing power against inflation. To manage these shifts, I offer 5 principles of asset allocation. Risk and reward are related. The longer you hold your investments, the less risky stocks become. Dollar-cost averaging, investing a fixed amount at regular intervals, reduces the impact of market volatility. Periodic rebalancing restores your portfolio to its intended risk level and can even enhance returns. Distinguish between your emotional tolerance for risk and your actual financial capacity to bear it. I also emphasize 3 practical guidelines for tailoring a life cycle plan. Dedicate specific assets to specific goals. Recognize your true risk tolerance, and save regularly no matter how small the amount. Consistency, not brilliance, builds wealth. Life cycle or target date funds now automate much of this process, gradually adjusting your portfolio as you age. For many investors, they are a simple, low-cost solution. But even with a perfect plan, many people fail to prepare adequately for retirement. Some underestimate how long they will live or how much they will need. Others fail to adjust their lifestyles or start saving too late. To those nearing retirement, I recommend a hybrid approach. Maintain some stock exposure for growth, hold sufficient bonds for income and stability, and consider annuities for guaranteed income if you fear outliving your savings. The objective is not to maximize wealth, but to maximize peace of mind, to sleep well, not just eat well. Finally, in Chapter 15, 3 Giant Steps Down Wall Street, I summarize everything into 3 practical paths any investor can take. The first step is the no-brainer: investing in index funds. An index fund buys and holds all the stocks in a broad market index, like the S&P 500, minimizing costs and taxes. By doing nothing, you outperform most who try to do everything. The evidence is overwhelming. Over time, low-cost index funds beat the majority of actively managed funds. Simplicity triumphs. The second step is for those who wish to be more hands-on, the do-it-yourself approach. For such investors, I provide a few timeless rules. Confine stock purchases to companies capable of sustaining above-average earnings growth. Never pay more for a stock than can be justified by its fundamentals. Favor companies with compelling narratives of growth, but always anchored in value. Trade as little as possible. Activity is the enemy of performance. The third step is for those who prefer to delegate, hiring a professional advisor. But I caution that this should be done with care. Many advisors add little value after fees. The best ones act as coaches, not fortune tellers, helping you stick to your plan through market turmoil. I also discuss how to evaluate mutual funds and ETFs using services like Morningstar, and how to understand what a truly balanced, tax-efficient portfolio looks like in practice. I conclude with what I call the Malkiel step, the recognition that even the most sophisticated investors eventually come to appreciate simplicity. The wisdom of the market, expressed through low-cost indexing, remains undefeated. As the book closes, I reflect on the entire random walk. Investing is not about chasing luck or timing the next boom. It is about patience, consistency, and trust in the long-term resilience of markets. The random walk does not mean chaos. It means humility. We cannot predict tomorrow's prices, but we can control our behavior, our costs, and our time horizon. Those are the levers of success. In the end, Part 4 is not just a manual. It is a philosophy of life. It teaches that financial independence is not won by brilliance, but by discipline, not by speculation, but by balance, not by speed, but by endurance. Whether you are a young saver or a retiree, the path is the same. Keep walking, stay diversified, ignore the noise, and let compounding do its quiet magic. That is the true essence of the random walk. Not the randomness of markets, but the steady wisdom of walking on.